Good afternoon. So, we are looking at the role of expectations and interest rates on the exchange rates. We are re-looking at the foreign exchange market, and the other day we discussed diagrammatically the role of expectations and interest rates. How do expectations and interest rates have an impact on the exchange rate? So, I am going to for your benefit, I am going to redraw the ED and the ES curve, the excess demand and the excess supply curve, and then again try to understand the role of expectations in changing the exchange rates in a country. So, this diagram, on the y axis you have the exchange rates. It is a unit of foreign currency, 1 unit of foreign currency expressed in units of domestic currency, and then you have the usual downward sloping ED curve, and you have an upward sloping ES curve. The ED curve is the excess demand curve for the investors, speculators. Investors, speculators are driven by something called the open interest differential, which is given by pi hat plus r star minus r. Of course, at this point where you have an equilibrium where ED is equal to ES, you assume here that r star hat is 0. So, we are looking at the re-looking at the foreign exchange market, and we have the downward sloping ED curve and upward sloping ES curve. ES is the excess supply curve, ED is the excess demand curve. Excess supply curve is upward sloping because of the assumption that if pi rises, it leads to an improvement in the current account balance, and there is excess supply of foreign exchange. ED curve is downward sloping because this ED curve is the demand by the investors and speculators. So, in case you are at point this where ED and ES intersect and there is equilibrium, and pi hat is pi E minus pi by pi. If pi reduces, then this pi hat term goes up. It leads to an open interest differential and an increase in excess demand for the foreign currency. So, you have the downward sloping ED curve, you have an upward sloping ES curve, and this is upward sloping because if pi increases, you see an improvement in the current account balance. So, this is made on the assumption that the MLR condition, the Marshall-Lerner-Robinson condition, holds. Okay, so, this is again re-looking at the foreign exchange markets. Initially, you have r is equal to r star, pi hat to be equal to 0, ED is equal to ES. Now, there is something which happens, which is the change of expectations. the change of expectations is that in this economy, if the market participants start feeling that after an year's time your own country's currency will depreciate because of various reasons, you fear that there will be global recession in the next year also. So, there is a possibility that it will lead to an increase in imports in the next year, or there is a possibility that there will be some situation where the two Gulf countries have a war, and that has an impact on the Indian economy. So, you fear that there will be an increase in imports after a year's time. So, what you fully anticipate, underline fully anticipate, is a shift of the excess supply curve to the left. You anticipate that maybe tomorrow or next year there will be an increase in imports, and your currency may depreciate after a year's time. Now, see how that thing has an impact on the actual exchange rates. People are just thinking that your currency may depreciate after a year's time. That has an impact on today's exchange rates. So, expectations have a role to play in determining your exchange rates. Till date, we have studied the open interest differential, where we said that depreciation is a function of the interest differential. Now, I have brought in another parameter, which is expectations. If you expect that your currency will depreciate, it does have an impact on the actual exchange rates today. So, what happens is that you are expecting that your currency would depreciate. This would mean that if you are looking at the open interest differential, especially this term pi hat, which is the expected rate of change of exchange rate, you expect this to go up. So, you expect pi hat to go up. That means foreign currency, you expect foreign currency to appreciate or your currency to depreciate. It leads to an increase in open interest differential. When it leads to increase in open interest differential, there is incentive to invest in foreign bonds. When you have to invest in foreign bonds, you would demand foreign currency. When you will demand foreign currency, the ED curve will shift to the right, because ED curve, the ED curve shifts because of two reasons. One is the foreign interest rates, the other is the expectations. So, the ED curve shifts to the right, but because every investor speculator is not risk neutral, he is risk averse, he will not completely switch into foreign bonds. Okay. So, that is the reason that the ED curve, which shifts to the right, the currency depreciates to P dash only and not to P double star. So, there is this excess demand, the exchange rate moves to P dash, and this excess supply of foreign exchange is met by the other market participants, because with an increase in pi, there is an increase in excess supply because the Marshall-Lerner condition holds. So, the new equilibrium point is P dash and it is not P double dash, but it does bring stability in the system if the actual exchange rate after a year's time moves to P double star, because in that case, if you are at P double star, then it brings stability, because the investors, speculators would think that they can buy the foreign currency at P dash and then probably after a year's time sell it at P double star. So, if the actual exchange rate works out to P double star, speculation brings stability in the foreign exchange market. All this time we had used speculation as a word pejoratively. I mean, we would think, oh, speculation would always bring disorderly conditions in the market. But this is a case where speculation brings stability in the system. But there is another possibility. After a year's time, your currency may not depreciate. In fact, it may remain here only, here at this point, that equilibrium point. Then investors, speculators have to revise their expectations. But in that process, they would lose, because they had thought that they would buy exchange rate at a price P dash and sell it at P double star, but it worked out to be lower than P dash. In this case, they would lose. And then in this foreign exchange market, you have to make quick decisions. You may be rational or you may be irrational. It is not a question of that, it is a question of how quick you are in making your decisions. So you may, so there will be some speculators who will make profits, but there will be some who would lose, just because the decisions have to be quick in the foreign exchange markets. So this is a case where the expectations, you had expected your currency to depreciate, and your currency indeed depreciated, and in that process the speculators, investors made profits. Yeah.
What could possibly get back the equilibrium point to P star? Because if after 1 year the BOP, balance of payments actually improved and the ES curve shifted upwards, then we would get P double star. But what could get the equilibrium back to P star once it's reached P?
So if it's yours is P dash and it's P star, so if the actual exchange rate moves here, right. So this thing that pi had, that open interest differential, would become 0, and here you won't have any open interest differential. So this will be like an equilibrium. So this thing goes up and you reach a point like this where the open interest differential becomes 0. I am talking of a situation where this doesn't move. Okay. So then, yeah, it stays here. So what will prompt the market participants to revise their expectations? Something will happen in the economy, and remember, when pi gets increased, there will be some sort of a current account surplus, and when you have a current account surplus, you know what happens to the exchange rates. What has to appreciate? Ours or theirs? Ours would appreciate, theirs would depreciate. So this thing, instead of going up, will go down, and then you have to revise your expectations here. Okay. But in that situation, investors, speculators would lose, because they had thought that it would rise, but it would go down. Now this is when you fully anticipate that there is a shift of the ES curve, or there are smart people in the markets who already know that after a year's time our currency may depreciate. But look at a common man, he is not thinking what will happen to our exchange rate after a year's time. So think of a situation, a second situation, when you do not fully anticipate the changes in the ES curve. So in that case, what happens is that the ES curve in fact shifts, and then you come to know that your currency has depreciated. Okay. So you are not fully anticipating the changes. You find that tomorrow $1 becomes 60, for example. Now that's a situation where your exchange rate depreciates from here to P double dash. But now look at a situation which is different from this, from the earlier one. Now because it has reached here and you have a current account deficit, now the expectation is that the exchange rate will now come down from P double dash to this equilibrium point. Okay. So then now when the exchange rate has moved up, it has depreciated. Now the expectations is not that pi e will go up, the expectations is that it will go down, and therefore you would have foreigners who would like to invest in your bonds. In that situation, again, if the investors, speculators think that now they could sell at this at this rate and then buy it later at a lower price, this is what they would think now. But if the actual exchange rate works out to be P double dash, then it will bring instability in the foreign exchange market. If the actual exchange rate turns out to be this point, then it brings stability in the foreign exchange markets. So that is how you would look into a situation where you do not fully anticipate the change in the exchange rates. Let me repeat again this point. This is a situation which is different from the first. The first was a situation where you would expect that after a year's time your currency would depreciate or foreign currency would appreciate. The second situation is that your currency depreciates and you come to know today that it has become $1 has become 60 rupees. Now look, your currency has depreciated, there is a current account deficit. Now there is something which happens to the expectations. Your expectations are not that they are going to rise, but your expectations are that it will come down to this situation. Okay. So that would mean that there will be an incentive for foreigners now to invest money in your domestic bonds. But there is always a possibility that the actual exchange rate may shoot up to P double star, or it may remain here. It may be a point which is below P double dash. If it is a point below P double dash, then investors, speculators would make profit, because then they would sell it at P double dash and then buy it at a lower price. But if it works out to be P double star, then you would sell at a lower price and buy at a higher price. It brings instability in the foreign exchange markets, and these decisions have to be quick. So any investor, speculator can make losses because of this. So what I am trying to communicate is that these expectations do pull up these exchange rates. And we saw that here, because you had investors, speculators on the one hand, and you had the other market participants, these changes in interest rates and expectations do have an impact on the changes in the exchange rates. Now think of another interesting situation where you have an ED curve which is not downward sloping, but it is perfectly horizontal. Now this is a situation when all investors, speculators are risk neutral. Risk neutral means that they consider domestic and foreign bonds as perfectly substitutable. So as soon as they find that there is an open interest differential, they will completely switch out from domestic bonds into the foreign bonds. And you have the upward sloping ES curve, which is the excess supply curve. It is upward sloping because the Marshall-Lerner condition holds. If there is an increase in pi, it would lead to an improvement in the current account surplus, because the MLR condition holds. So this is a case of risk neutrality. where the ED curve is perfectly horizontal. Now, think of the same situation. The first situation, there is a change of expectations, but you fully anticipate the changes in the supply curve. That means you think that after a year's time your currency would depreciate. You are just thinking, that means the market participants are thinking that tomorrow there will be, or maybe after a year's time there will be a surge in imports because of various reasons. It would have some impact on the exchange rate. Your exchange rate may depreciate. So, this is what you are expecting. You are expecting your currency to depreciate, foreign currency to appreciate, and reach a level of P double star. Now, what it will do is that it will immediately prompt the ED curve to shift. It would shift immediately to that point, so that the exchange rate moves from this equilibrium point to P triple star. So, here there was a lagged response of the exchange rates. The exchange rate depreciated by some amount, and then later on it went up to its final equilibrium value. This was because this ED curve, you had assumed that people are risk averse, they do not completely switch out from domestic bonds to foreign bonds. But here the difference is that as soon as there is a differential, that differential cannot hold for long. As soon as you find that something is favoring you, you completely switch from domestic bonds to foreign bonds. So, that differential never remains, your exchange rate immediately moves to P double star. So, it is like a self-fulfilling prophecies of each individual. You felt that there will be some depreciation, and then in actual practice you saw that the exchange rates did depreciate immediately. Okay. So, this is a case of risk neutrality, where your exchange rates immediately depreciates after the expectations were that it will depreciate after a year's time, but it did have an impact. It did pull up the price of the foreign currency, and your currency depreciated immediately. No, making profits one time. Say if you have a higher interest rates, you would immediately put your money and that is finished. Nothing like sustaining. Remember when we were discussing the Mundell-Fleming model, that KK curve was made with the assumption that there is imperfect substitutability between domestic and foreign bonds. If there is perfect substitutability, I said that the KK curve is horizontal. Reason that in case there is a differential, there will be a one time switch, and therefore the differential will not hold, and it will be a one time shift only. So, there is a profit motive, but there is a one time shift, finished after this. So, that is what happens here. The E dash S dash curve shifts up, and so does the E star D star curve. Here there was a difference. So, there is something interesting about the exchange rates. In the 70s, there was work which was done by MIT professor Dornbusch. Professor Dornbusch has also written many macroeconomics books. If you, I do not know whether at present you are looking at Dornbusch. So, he was looking at the foreign exchange markets, and he gave a model of exchange rate overshooting. So, he gave a model of and he was concerned about the exchange rates which overshoot their targets, and there are other variables in the economy which are pretty much sticky. They do not change immediately with the changes in other variables, but you have this exchange rate which moves swiftly and then overshoots its target, and then over time it comes back to the equilibrium. But there are others which do not change, the prices do not change immediately, it is over time that prices change, and then eventually you see an equilibrium in the long run. I am not going into the detail of this model, but the story is something from what we had already discussed. Remember the ISLM framework that we discussed? We discussed the effectiveness of monetary policy in the case of fixed and flexible exchange rate. We discussed the case of fiscal policy in the wake of fixed and flexible exchange rates, and then we brought in capital mobility, no capital mobility, little capital mobility, high capital mobility and perfect capital mobility. The results were the following: monetary policy was ineffective in raising incomes and employment in the case of fixed exchange rate, whether with no capital mobility, with limited capital mobility, high capital mobility or perfect capital mobility. Monetary policy was ineffective in raising incomes and employment. Reason: remember, when you increase money supply, the interest rates go down, the incomes go up, the imports go up. So, you have a deficit. When you have a deficit and it is a fixed exchange rate, someone has to intervene in the markets to bring to have parity in your exchange rates. So, that someone is the central bank intervenes, they lose the foreign exchange, but loss of reserves is related to the decline in money supply. So, when you had increased money supply initially to raise incomes and employment, but then the changes in reserves had an impact on the money supply went down, and so the LM curve which had shifted to the right would shift to the left, and you will be back to the equilibrium. This is when you do not even have capital mobility. If you bring in capital mobility, that means if the interest rate goes down, according to the Mundell-Fleming framework, there will be a capital outflow, you will have a heavy balance of payment deficit. Someone has to intervene in the foreign exchange markets. As soon as you start losing reserves, it will decrease the money supply swiftly. So, your LM curve which has shifted to the right will swiftly move back to its original position. You do not have monetary independence in case you have a fixed exchange rates. So, all countries who adopt a fixed exchange rates are concerned about the monetary independence. This was the monetary policy. What was the impact of monetary policy on income and employment when you have a flexible exchange rates? It was altogether different, it was totally opposite, because if you decrease money supply, incomes go up, imports go up, you have a balance of payment deficit. This is not a fixed exchange rate. So, your exchange rate needs to depreciate. When your exchange rate depreciates, your IS curve shifts to the right. Okay. Your IS curve shifts to the right. What if you bring in more capital mobility? What happens if you bring in capital mobility? No, because when you bring in capital mobility, interest rates have gone down, there is a capital outflow, heavy balance of payment deficit, more depreciation of the currency, larger shift of the IS curve to the right. So, your LM curve shifts to the right, IS curve shifts to the right. Monetary policy is totally effective in increasing income and employment in the case of perfect capital mobility. Now, I want to go a step beyond this. Now, here remember right from the beginning we had made these stringent assumptions that prices are fixed. Then we had said sterilization, then we slowly relaxed that and we said there is no sterilization. Now, please assume what happens if you assume that the prices change. If the prices change, something happens in the economy. This whole thing, that the ISLM framework and the effectiveness of monetary and fiscal policy was built on the assumption that the prices were fixed. Now, assume that the prices change. What do you think will happen in this case when you have a flexible exchange rate and the prices go up? My hint is, please look at this variable m by p. Please look at the variable m by p, e p I want you to look at these parameters in the short and the long run, assuming that the prices now are changing and you have a flexible exchange rate. So, the story there the day before yesterday ended when we said that the monetary policy is effective in raising incomes and employment in case of flexible exchange rate. Now, remember, when you increase incomes and you assume that the prices are also a variable, the prices go up. So, the real money supply, remember what had happened? You had increased money supply, now the prices are going up. So, your real money supply reduces. So, when your real money supply reduces, see what happens. The exchange rate which had depreciated would now appreciate because your real money supply is going up, your interest rates are going up. So, there is an inflow of capital coming in, which is having an impact on the exchange rates, right. So, then what happens is that what Don Bush was saying, that when you increase money supply, in the short run the exchange rate overshoots its target, but when as soon as the prices start increasing and the real money supply reduces, your currency starts appreciating. So, when you had increased the money supply, the exchange rate overshoots its target, and then when the prices start increasing, the exchange rate also returns to its equilibrium position. So, the story of the exchange rate overshooting comes from what happens to these parameters in the short and the long run. So, then if there is an increase in money supply, m by p increases, there is no impact on prices in the short run. This is the story that we had read a couple of days back, 2 days back, that there is effectiveness of monetary policy in the case of flexible exchange rate. You see immediate depreciation of the currency because of the same argument, incomes go up, imports go up, you see depreciation of the currency. So, in the long run you would see changes in the exchange rate, but this exchange rate which had depreciated and it had overshot its target, because of the changes in prices it will be back to equilibrium. Reason being that when the price go up, LM curve shifts to the left, the real money supply reduces. So, you see an increase in interest rate, there is capital coming in which leads to appreciation of the currency. As a result, you see changes in P, but no changes in E P star by P, because now P also moves, E also moves, the real exchange rate remains as it is, there is no change in E P star by P, and there is no change in incomes. Okay. So, so I can just think about it. You can see a diagram where you put, say, money supply, exchange rates and price on the y axis. So, you have three things: money, exchange rates and price on the y axis, and you have time on the x axis. So, what happens in the short run is that if you increase money supply, the variable which gets affected immediately is the exchange rate. It so the exchange rate, it overshoots its target, reaches a point like this. The money supply increased to 150, exchange rate overshot its target and reached here. The prices in the short run, they are sticky, they do not change. So, the short run thing is prices as it is, money supply has gone up, exchange rate, the change in exchange rate is greater than the change in the money supply. And but then in the long run, with time, over time, the prices go up, the exchange rate also comes back to its equilibrium position. So, in the long run, you have all these three which are together. So, that is just a simplistic version of what Dornbusch was trying to say, that there are other variables which have a lagged response, but exchange rate, it first overshoots its target, and only when the other variables change over time that the exchange rate will come back to its equilibrium position. So, that is all that I have today. Tomorrow we are going to discuss the derivative markets in international trade.